If you were expecting clear signals about where the Indian economy is headed, the latest GDP figures are a mixed bag. The third wave of COVID really caused a break for the economy in the Jan to March quarter, slowing the GDP growth rate for a fourth straight month to 4.1%. The economy had grown by 1.6% in the same period last year. Meanwhile, the annual GDP growth in 21-22 rose to 8.7% versus a contraction of 6.6% in the COVID-hit 2020-21 period. Powering this charge was a 3% growth in the agri sector and a 9.9% growth in the manufacturing sector. The construction sector grew by 11.5%, financial services by 4.2%, and trade and other services by 11.1%. There was meanwhile some good news, with the 8 infrastructure sectors rebounding in April to 8.4% growth versus 4.9% in March. Joining us on the show, Madhvi Arora, lead economist at MK Global Financial Services, and Prasenjit Basu, chief economist at ICICI Securities, to discuss these headline numbers. Madhvi, let me start off with you. Did they meet the estimates you had in mind? Were you disappointed with either of the headline figures?
No, I think the numbers were largely in line with our expectations. We were looking at close to around 3.9% in the fourth quarter, as against 4.1%, which was expected by the implied numbers of CSO. So I think to a large extent it was in line. On the production side, of course, we were seeing impact of Omicron-related curbs, which likely seems to have slowed the fourth quarter recovery, especially in the contact-sensitive intensive services. Moreover, we also were seeing rising input costs, which would have probably added, further pressure on manufacturing growth, and that's why we saw a much lower manufacturing growth on a sequential basis. At the same time, the high base of last year also had weighed on the YOY growth numbers in fourth quarters, and we also see some revision in the early part of this year in terms of first quarter numbers. So I think on net basis, not much of a surprise in the fourth quarter. For the full year, we were expecting a revised number of 8.7%. So I think pretty much in line with our estimates as far as the FY22 numbers are concerned.
Okay. Prasenjit, what do these numbers really portray in terms of growth going forward, the kind of prospects we're looking at for the current year?
Well, I think the most heartening feature of the numbers is the pickup in fixed investment spending. Fixed investment spending grew in real terms at 5.1% in the latest quarter. Nominal growth was about 15%, over 15%, and that suggests that we are seeing an acceleration, a steady pickup in fixed investment spending. To our minds, that is really the likely story of what will drive India's growth in the period ahead in the current fiscal year. I think also that India has been underestimating real GDP by quite a bit over the last 2 or 3 years, because there's a very wide gap between the balance of payments, current account balance, which is measurable and observable. That is generally running at about just over 1% of GDP for the full fiscal year. But if you look at net exports, the nominal net exports of goods and services for the fiscal year, they're running closer to 3% of GDP. That is a very wide gap. And if you look at the real number, it's over 5.5% of GDP. Real is based on deflators of exports and imports, and it basically is saying that our export prices are rising much faster than our import prices, and so there's a very wide gap in real terms or in inflation adjusted terms between exports and imports. That is completely, it defies logic. So in fact, not just this year, but for the last 2 years, I am estimating that that the official GDP numbers that are being put out by CSO are actually about 2.5 to 3 percentage points lower than they should be, because of errors in the net export count.
Interesting. Madhvi, would you concur? And, we did also see quite a significant impact of Omicron. If we were to say this is safely behind us, perhaps we could look at more improved growth going forward.
No, I think the demand slack have persisted. I mean, before COVID as well, we were supposedly subpar with regard to our potential growth, and at this point also, even though it has reached the pre-pandemic level, and still at least still around 6-7% below the pre-COVID growth trend that we were seeing. Consumption remains stubbornly low, while the level of investment also is just about recovers to its pre-COVID level. So I think the divergence between languishing private demand and high core inflation has also been persistent for a very long time, in the last 2.5-3 years, which means that domestic supply chain disruptions in manufacturing and services, especially in the informal sector, haven't been repaired fully. So the GDP numbers that you are still seeing are not necessarily capturing the real picture as yet. And that said, even with the current 8.7 plus kind of a figure that you're getting on GDP, which is obviously on account of base effect as well, we are at this point in time still subpar, and we are still growing at least 6-7% below the pre-COVID growth trend. So I think it's not necessarily a very rosy picture, and while we comparing our growth numbers with the West as well, I think the kind of fiscal boost that those countries have gotten vis-a-vis emerging markets in general, the comparison is quite stark, and India wasn't fully growing in line with its potential in the pre-COVID as well, and currently, in fact, with the kind of the deep-rooted impact that COVID probably would have left into emerging economies, which did not really see the kind of fiscal boost that the advanced economies had seen. I think there could be a starring impact of that in labor markets, and which actually would probably show in the medium term in a more startling fashion. So I think we need to be a little cautious before sort of rejoicing the India growth picture, which is much higher than the rest of the world.
Interesting. Prasenjit, talking about being cautious, inflation, given what we're seeing in crude prices, still continues to be a bit of a red flag. How worried are you about the rate of inflation?
Of course, the current rate of inflation is certainly a worry, and the hope is that oil prices don't stay this high for too much longer, partly because you'll get a supply response from alternative energy as well as from some of the marginal sources of oil and gas, such as shale and tar sands in North America. So as that supply response comes through, I'd expect that Brent crude prices will moderate somewhat by about September, October and beyond. But of course, currently, the very high crude oil prices and broader commodity prices, including edible oil prices, are a bit of a challenge for India in terms of the monetary policy response and the fact that headline inflation is a lot higher than the inflation target. Now, I think it's also important, though, to be aware of some measurement problems that continue with this GDP number. For instance, it's reporting that the fourth quarter private consumption expenditure in India only grew about 1.8%, despite the fact that nominal growth in private consumption was closer to 13%. Now, now CPI inflation is currently a lot higher, but in that quarter, CPI inflation was just over 6%, and the private consumption deflator that is being used in India appears to be the WPI rather than the CPI, which is largely inappropriate. You should be using something closer to the CPI as the deflator for private consumption. And if that is the case, then private consumption will be a lot higher in terms of real growth than is being reported in these numbers. So I think there are measurement issues that continue to plague our statistical indicators, particularly GDP. Real GDP, I think, is being underestimated, and this continues to be the case in the current quarter. Now, of course, relative to the rest of the world, India is currently the fastest growing large economy, likely to stay that way this year, and that is something to be celebrated. But we are, as Madhavi correctly pointed out, we are needing to catch up, because we've had about 2.5 to 3 years of subpar growth, and really growing 8.7% is not enough to make up for that period of subpar growth that we've had. So we need to continue to see rapid economic growth in the period ahead, and the fact that investment spending is picking up strongly is, to my mind, a very positive sign. And of course, in terms of exports, India has seen the fastest export growth of any country in the world over the last 16 or 17 months. In 2021, the calendar year, India's exports grew 41.6% in nominal terms, nominal US dollar terms. That is easily the fastest in the world. So we are benefiting from a global recovery, but in fact, our export sectors are gaining ground, gaining competitiveness, which is, these are the two positives. Exports and investment are beginning to turn around.
All right. Just to come back to inflation, and now that we're seeing the monsoons and the advent of the season as well, Madhavi, again, do you feel perhaps there might be some relief inside, given that the monsoons are expected to be on track, and could this also play a factor when it comes to growth as we progress through the year?
Yeah, to some extent, yes, because India on a net basis is a global agri-commodity exporter, so that sort of at least gives us that kind of shield that we may not see as high cereal inflation, and we have to again see how much of MSP increase the government actually gives, because that will be a big input in my forecast for food inflation in general. But I think overall for the year, we still are going to be seeing an inflation which will probably hover about 6.5%. So that would be, even after taking the recent measures that the government has announced, I think which could probably have a downside inflation impact of around 40-50 bips overall, including the second round impact. But I think we could still see inflation hovering at close to around 6.4-6.5% for the year, which I think could again worry the policymakers in general, because in the end, a very high inflation doesn't augur well for growth in the medium term, and thus could act as a restraint point as far as policy ambitions are concerned on increasing the growth picture beyond the trend growth of 6-7%.
Right. So if I had to pin you down for a year-end target, then Madhavi, what would be your GDP target for the year?
So we were looking at 7.3 before this print. I think that there could be a mild revision close to 7%. I'm not looking at a very high downward revision from my earlier forecast of 7.3 for FY23. All right, and in one line, Prasenjit, from you as well, year-end forecast?
Yeah, my forecast for the current fiscal year, I think I'm likely to revise it upward. This year's number is a little bit lower than I would have expected, and I think there's a cushion in terms of net exports, both in nominal and real terms, because that is being underestimated. So I think growth will be about closer to 8.5% in the current fiscal year, with an acceleration thereafter, given that we have an
Madhavi is smiling because yes, it's always good to hear the positive numbers, but she's definitely playing a bit more cautious and a much more bullish view coming in there from Prasenjit. But that's the that's the headline number that we're looking at today. Both of you, thank you so much for your time and for really taking us through some of the factors at play and behind your reasoning for how this year is likely to pan out. Thanks so much for joining us. We're going to take a very quick break. Back with more news on the other side.